and I will post this. And I'm going to start sharing my screen.
I feel like I'm underdressed. Hang on.
That's fine. Don't worry.
Hang on.
Put your jacket on.
Put a jacket. Hang on.
Yeah, okay. Should I do all my buttons?
I'm gonna get too hot now.
Yeah.
Okay.
All right. So this is the raw version of your mid-semester exam. I'm going to quickly show you because we have to put every question onto the LMS such that we didn't worry about the formatting. So this does not look like your past exam papers that we gave you, the 2018 one. But yeah, we're going to go through each question and unmute yourself to raise question if you want more clarification or join the conversation anytime. All right. So we have about 3 questions allocated to chapter 1. We don't have the marks here, but did you happen to put a point where that is going to be like 4 points or 2 points each question in this version, Daniel?
No.
Okay, no worries. That's fine.
That was set in LMS.
That's fine. That's fine. I mean, given that everyone can read it and it's paused anytime, and we probably we can probably extrapolate the difficulty by just looking at the question. So question 1, which of the following is incorrect? So here, the one is highlighted is the answer. So which makes the other 3 options correct. So A, the financial manager must weigh the cost and benefit of each investor or project and decide which of them qualifies as good use of money shareholders have invested in the firm. Yeah, that sounds reasonable. Financial manager must decide whether to raise more money from new and existing owners by selling more shares of stock or to borrow money instead. Yes, it's like financing decision, yes. And a financial manager's decisions fundamentally shape whether a company adds value, yes. So that means we haven't looked at C yet. Managing working capital is more important for mature firms and often means the difference between success and failure. So would anyone want to point out why this one is incorrect?
Regardless of what third parties' monies may be managed from a financial firm or be it a project or what have you, it's as important above board for every situation. Why would it be more important for capital from mature firms, say, compared to new companies? You know?
Yeah, I mean, what Luca's saying is generally correct, right? But I guess the main point for why option C here is incorrect is because if you have to make a comparison, relatively speaking, managing working capital is a lot more important for younger firms, right? Because I mean, working capital is defined as
that's true.
Current asset minus current liabilities, right? So which means you have to meet all the cash flows, meet all the needs, and that's even more important for younger firms, right? Daniel, do you want to just take turns or?
No, you can keep going.
All right, sure.
I got the statistics on that question.
Okay, what's the statistics?
59% got that answer.
Oh, cool. That's better than 25%, right? Which is not bad. Better than flipping a coin. And yeah, it's better than flipping a coin as well. Question 2, maximizing the value of the firm can also be described as maximizing the value of the company's ordinary shares. We're trying to maximize the shareholders' wealth, right? So it's not a goal of accounting profit, not the interest rate charged by creditors of the firm, maximizing the sales revenue of the firm. So, I mean, this question, what's the statistic on this question, Daniel?
80%.
80%, cool. That's good. Yeah. So this one should be, I mean, because the other 3 are kind of equally likely, you have to pick the other one of the 3. So I would say probably A sounds a lot more reasonable if it's simply guessing, right? I'm coming from the point. And any questions so far? I mean, feel free to stop us anytime if you say, I'm not sure about why D is incorrect, for example, right? Just feel free, okay? Question 3, an investment decision is distinct from a financing decision in that here the correct answer is B, investment decision about deciding on which new investment should be undertaken, where financing decision consider how to fund the capital needs of the investment program. And those 2 are independent, right? You shouldn't, they should be judged separately. And for A, that's the opposite, right? You switch the order. Financing is about finance, how to get money, and investment is about what possible make investment to be made, right? C, investment decisions relate to reviewing past investment programs while financing. So why is C incorrect? I suppose the keyword here is past, right? Investment decision relate to reviewing what you're going to take, we're going to undertake, right? How to maximize the profit, shareholder wealth, and the NPV, net present value, not net past value, right? So that's the future investment. And financial decision relate to choice about a firm's financial asset base, while investment decision relate to choice about physical assets. Again, that's wrong, right? You can investment decision, you can also buy, like, for example, by some trademarks, by copyright, by innovations other firms make. It doesn't have to be physical asset. So that concludes our chapter 1 questions. So
most students did pretty well on the chapter 1 questions.
Yeah,
because that question 3 was 87%.
Oh, good. So chapter 2, question 1 easy. We even indicate as easy to ourselves.
I've just forgot to delete that one.
Yeah,
I had
that's
all
fine.
of them as easy and hard and whatnot.
So
then I just thought that it would be better to just just forgot to delete that one.
Okay, so which of the following is correct? Let's look at a correct statement first. A company purchasing a new machine with cash, that's the same, will have no changing asset on the balance sheet and a decreasing profit on the income statement. So the reason why that's correct, because the other 3 are deferred, right, is because when you're buying a new machine with cash, the cash goes down in your current asset, but your long-term asset goes up, right? So you're on the asset part, the balance sheet part doesn't, there's no change, but there's a decreasing profit. And why does a decreasing profit? Where does that decreasing profit come from?
The expense goes up.
The expense coming from the depreciation expense, right? Yeah. So that's why, right? So yeah, income statement. So over here, decrease in increasing asset, that's wrong. Decreasing asset, that's wrong. We have an increase, again, that's just wrong, right? As long as you figure out there's going to be no changing asset, you pretty much nailed it, right? You don't have to worry about the second part.
It's actually a bit interesting. Like in A, B, and D, you have assets are changing. Only C is the one. C is the only option where assets aren't changing.
Yeah. All right. So question 2 relates to examine this balance sheet. So here they had 7.8 million shares outstanding. The price per share is $34. What is the market to book ratio? The market to book ratio refers to the market equity over the book equity, book value of equity, right? So the market value of equity is calculated using shares outstanding times share price, 34 times 7.8 million, divided by the book equity, which is 140, right? 140 million. 140 million. That's 2020 figure, and you should be able to get 1.89. How many people get it right, Daniel?
About 70%.
Okay, that's pretty good performance given the average is about 50%.
Hey, could you please repeat how you got that again, please?
So the market to book ratio is calculated using the market value of equity, which is calculated as share price.
Share price, yeah.
Times number of shares outstanding.
So market capitalization times.
Which is the market capitalization divided by book value, which is shareholders' equity over here, 140.
So essentially market cap divided by book value, yeah?
Yes, that's right.
Thank you.
All right. This question is guaranteed not to come up in your final exam, so don't worry. Refer to the balance sheet above the changing in your exam. Of course, that balance sheet is pasted here again, right? The change in company XYZ working capital from 2019 to 2020. Working capital here is defined as
that answer.
Current assets take away current liabilities.
That's right, current asset. So which means that you just need to work out the ratio of that, right? So what do you have before? 154 minus 99, and then what's the new one? 150 minus 95, and then looking at a ratio and the change.
That answer there's wrong. The answer was 3.77%.
Yeah. So unfortunately, we changed the number, but we didn't change that value over here.
We just didn't change this document.
So again, just need to know how to do that question. Question
So
4.
what happened there? That's wrong. The answer is it?
No, the
Yeah.
answer is wrong. Yeah, the numbers are different from your version of your
Oh,
exam.
good.
Yeah,
Because
but
we inputted the questions into LMS and then we changed some of the inputs in LMS. So this is just a draft of the exam essentially.
Okay. So the answers and questions don't correlate 100%. There are.
I mean, I'll
there are a
tell
few
you
nuances.
if they're like, so for this question, the answer was 3.77% rather
cool.
than,
Okay.
yeah, 7.84. Okay, and question 4. A company has an earnings to price ratio of 12.5. Earnings to price means that, would anyone remember what earnings to price ratio means? Your earnings divided by the share price, right? Earnings to price. And the current share price of 56. So from that, you can work out what the earnings is 56 times 12.5. In 2020, you find in the company's financials that they have earnings of the year of 1.2 billion, cash, and a debt of $950 million. What is company's enterprise value? So to calculate the enterprise value, you need to have market cap minus debt plus cash. So in order to get a market cap, we need share price and a number of shares outstanding, right? And we just need to figure out how many shares outstanding for this one. So do you have the numbers there, Daniel?
yeah, well, so the shares outstanding was 96. So you would have your 96 million.
Yeah, so that comes from 56 times 12.5, and then it's which 1.2 billion divided that, you get number of shares outstanding.
And you did so 56 times 12.5 divided by 1.2 billion.
It's actually 1.2 divided by brackets of 12.5 times 56, because here the share price is 56. You want to work out what the earnings here is, earnings per share, and that will be 56 times 12.5, and that gives you earnings per share. And in order to work out number of shares available, that will be 1.2 billion divided by earnings per share to work out how many shares that you have, and then use that number times 56 to give you the market cap plus 800 minus 950. That will give you the answer, 5.526. Right? Is that clear to everyone? Kind of. What's the stats on that question, Daniel?
That's pretty good. 66%.
Okay, so 1/3. Last question for chapter 2. A company has a tax rate of 35%. Operating expenses increased by 12 million and purchased new machine was 80 million. That will be completely depreciated over the next 8 years. The company's profit after tax will decrease by, even tells you decrease by. So increase by 12. And here is an extra bit of 10 because 80 million cost divided by 8 years. So it's that $10 million in depreciation every year. So that is another $10 million add on to the expense. So that is 12 plus 10, 22. 22 times the after fact tax rate, right? So
35.
yeah, that's how you get 13.
Sorry,
And
what was that, Frank?
is 12.
Oh, okay. So this is
Plus-
actually a different question in the exam.
Oh, really? Okay.
Yeah. So this was a question that we decided just to make a bit easier.
Oh, yeah.
But we didn't remove the information in the question itself. We just changed the question to if the machine is depreciated evenly over 10 years, then what is the depreciation expense each year?
Oh, that was $10 million. That would be $10 million. Yeah. So
$8 million.
Yeah, sorry, 8.
So after tax. So yeah, it would be after tax.
Yeah. But this question is slightly harder than the exam question, that you have to incorporate both its operating expense as well as the depreciation expense to work out what is the impact on the after tax.
Yeah, in the question, it was an $80 million machine depreciated over 10 years. So that meant that the asset the machine would have a depreciation expense of $8 million per year.
Mhm.
And it was quite interesting to see that, given that we had put in this kind of this other information, such that we had a company tax rate of 35%, some earnings and whatnot, a lot of students chose an answer that was quite different, although all we were asking for was what's the depreciation expense. We were just wanting to know what 80 divided by 10 was. And yeah, I mean, 59%, only 59% of people got it right.
Mm.
When we asked what the depreciation expense was. So that can be the case in some questions where you just kind of get this red herring, like this kind of information that's not relevant to the question. So it's really important. And essentially it's understanding, do you know what the question is actually asking you? So you should be confident in terms of what to do, I suppose.
So the answer's 8 million. Sorry.
Yeah. So that question is changed.
It's different
compared to your mid-semester exam.
Oh, okay. Thanks.
Yeah, so the question was simply saying, what is the depreciation per year? So we made it a lot easier by not asking you the company's profit after tax. We ask you, what is the depreciation expense every year? In that case, it's going to be cost divided by number of years, right? It's just very straightforward. But this version of the question that we didn't end up using is slightly more complicated, right?
Right. Yeah, gotcha.
There's a few more kind of more complicated questions in this version of the exam.
Yeah, we decided to dial down the difficulty level. All right, so chapter 3, question 1. An investment provides the following cash flows every year. If the no upcharge price of the investment is $7,000 and it has a return of 7% EAR, calculate the third cash flow that is received. So here, that what essentially what we're trying to do is to work out the present value of that at the present value of that at the present value of that at the present value of that equals to 7,000. So it's kind of like solving for X, where you just need to do it, right? I mean, we have a very similar question to that in the practice exam. So essentially, how you get 1841 is to buy 2100 divided by 1.07 plus 2300 divided by 1.07 square plus X divided by 1.07 power to 3 plus 2000 divided by 1.07 power to 4 equals to 7,000. Rearrange and solve it, you will get that, right? You'll get that question. All right, cool. Since no one's raising any flags, that was moving on to question 2. What's the stat on that question, Daniel?
On that one, it was 61%.
61%, okay. Still better than the average, right? We're looking for the question that is reducing the average. Question 2, a manufacturer of steel has the opportunity to purchase iron ore at 95 for 10,000. If he also buys, is this the same question as the exam question, Daniel? If you want to quickly check the numbers.
Yeah, it does look
different.
Yeah, no, it's the same.
Okay, good. Let me, if you don't mind, let me just quickly show you what I have, because I give me 1 second. So instead of just talking, I may be able to just give you the numbers. No, actually, I don't have. I didn't save that. So we can just work that out together. So, well, I mean, what we need to compare is that. Let me just use my iPad. Turn on my iPad. Start sharing my iPad. All right, can you see see like an iPad screen where I can write something? Question? Okay, perfect. So basically this one is talking about we have an opportunity to buy something. But then we don't need it, right? We only need, so what we're buying here is that we have iron ore that is trading at 95, but then we have to buy 10,000 units of that, as well as at the same time carbon, and it costs us $18 per ton, and we have to buy 50,000 tons of that, right? But we don't need that. All we need is 5,000 tons of iron, right? 5,000 tons of iron. And what's the alternative? Is that we can buy it from the market at $96 per ton. And we can also observe that the carbon costs about $17.50 per ton. So that means we have two costs to compare. The first cost one is that if I buy through the option, here I'm offering this option. If I'm buying through this, then I'll buy 95 times 10,000 plus 18 times 50K. But because I only need 5,000 of iron, so that means I'll be selling iron at the market price at $96 per ton, as well as selling carbon at market price. So this is cost one. And cost two here is that I simply just buy from the market. So we're comparing what's the magnitude of these two numbers, right? And given we want to reduce the cost, because this is the cost, we want to find the way that minimize the cost. And the answer will turn out to be, this is a slightly larger number than this number. And so that we will reject this option, we'll reject this opportunity, that will stick with the market plan, whatever that is available in the market, right? And this question also came up in your practice question, and it's just different set of numbers, and but the principle is the same. Any questions regarding this question? No? All right. Questions 3. Let's move back to the to exam.
Professor Frank, Daniel, I've got another unit to attend. Speak soon.
No, no worries. Bye, Lucas. I mean, this session will be recorded anyway. All right.
Pleasure. Thanks for that. Cheers. Bye.
Okay. Question 3 in chapter 3. Which of the following is correct? So, in a competitive market, the demand determines the value of a good. Why is that incorrect? Well, it's just me. I mean, the answer is that it's the price that determines the value, right? It's the price determines. And in a one-sided market, the supply determines the value. That is also incorrect. In a one-sided market is the whoever supplying the value. Well, it's actually, why is that incorrect, Daniel? In a one-sided market, because there's a bid-ask spread in the market. You can't sell and buy at the same price, right? Mm-hmm. So the supply determines the value of a good.
Because I think it's because the demand and supply would determine the value of the good.
Yeah. Okay. And in a competitive market, the cost determines the value of a good. Well, again, is the price that determines. So it is just really that one that we're looking for, is the price that determines the value of a good, right?
Because it's kind of similar to why A would be kind of incorrect as well. I mean,
Mm-hmm.
a lot of for looking at the statistics, a lot of students did choose A as their answer.
Yeah.
But in a competitive market, demand determines the value of good. Well, so does supply. So you can't just ignore the fact that there is a supply side.
Mm-hmm.
Yeah.
Sure. All right. So chapter 4. You open a new shop which earns $12,000 per year. However, as new business open near you, you believe your earnings will decline by 2.5% per year. Interest rate 6.75% per year. Then what is the present value of your shop closest to? So this is a question that is very similar to to your mixed method practice test. So here, what we have here is that we have cash flow, and you're gonna grow forever. So that means we're dealing with present value of a perpetuity with constant growth. The only trick here is that the growth is negative. So which means it's 12,000 divided by 6.75% minus negative 2.5%, right? So a lot of people just think that's going to be 6.75 minus 2.5, but it's 6.75 minus negative 2.5 because the growth rate is shrinking, right? It's decreasing. So which means the growth rate is minus 2.5%. That's the only trick with this question.
It's interesting. A lot of students said that this problem couldn't be solved.
Oh, really?
So, yeah.
Yeah.
I mean, the majority of students did get the correct answer, which is good.
All right. Let's keep going. In fact, let me try to see whether I can just do that over my iPad, because I just import the PDF into my iPad. So that hopefully that will be easier, as I can just write something on it.
Look at that.
That's beautiful. All right. So question two. Question two. Which of the following is incorrect? So the present value of a stream of cash flow is the sum of the present value of each individual cash flow. That's right. That sounds like definition. So let's go to C. The present value of a growing perpetuity is calculated by dividing a regular cash flow by the interest rate plus the growth rate. So I suppose, if you have the formulas beside you, you know that it's C divided by R minus G. So that means it's interest rate subtracted by the growth rate, right? But that's, some people tend to oversee that. I didn't see that's plus the growth rate. So what's the stat on this question, Daniel?
81%.
81%. Okay. That's good. So question 3, you have decided that you will need to have 75K in 5 years' time to be able to afford a down payment on a house. If you earn 8% per year, how much will you have to invest today? So this is just a single cash flow. Some people may think that because I've seen annuity over and over, and they tend to think, how much do I have to put in every year? That's one kind of mistake people make. But in fact, this one is simply just get you to calculate the present value, which is present value equals to 75K divided by 1.08 power to 5.
90%
right.
Got it right.
Yeah, that's good. Question 4, at the beginning of 2018, you invest in a perpetuity that pays $1,000 at the end of each year. The payment would increase by 2% per year and has an interest rate of 4.5%. Immediately after the payment is made, what is the value of the investment at the end of 2021? So knowing that there is going to be a perpetuity, there's going to be a growth rate, the only trick here is to figure out what is the C in this question. What is the C? So, and that involves you to draw a timeline. So here, 2018, that's 2018. So 2019, 2020, 2021, 2022, right? So 2018, at the beginning of 2018, you invest, that will pay $1,000 at the end of each year. So that means the first 1,000 to be paid at the end of 2018 or at the start of 2019 is $1,000, right? And the next one is 1,000 times 1 plus G. The next one is 1,000 times 1 plus G squared. And by 2022, that's going to be 1,000 times 1 plus G power to 3, right? And the question here is saying, immediately after the payment is made, what is the value of your investment at the end of 2021? So which means all these cash flows are no longer relevant. That they are irrelevant because you don't get to claim them anymore, right? So which means that what is available for you to claim is these cash flows and what is after that. So which means 1 plus G cube $1,000 times 1 plus G cube is the first cash flow in your present value of a new perpetuity constant. So that's what goes over here. And then the rest is plugging R minus G, and that's it. It asks you to say what is the value of your investment at the end. So you don't have to discount back to today. It's just saying at that point in time, 2021, what is the present value at that point. So draw a timeline. That's what it looks like. And all this cash flow are not relevant, but they are relevant in the sense to help you find out what is your first cash flow in your stream of cash flows. All right. Any difficulty with that question? Any questions? Any concerns? Any comments? All right. Then we move on to
in this version, Frank, I think the answer might actually be C.
Okay, sure. I mean, it's as long as you get the idea out, right? I haven't even done any calculation yet.
Yeah.
Question 5, you currently pay 4K per month on your 30-year mortgage. After 3 years, you find you're unable to continue paying 4K. The bank agrees to reduce your monthly payment by 10%. However, you will need to make a lump sum payment at the end of the mortgage. If your current mortgage rate is 2.9% APR with monthly compounding, what is the final payment you'll be required to pay at the end of the mortgage closest to? So what we have here is a monthly cash flow. So that means that we need the monthly interest rate. That's the first thing that you want to know, is that the interest rate will be 2.9% divided by 12. And you have made 3 years of payment, so which means you have 27 years of monthly payment remaining, right? This is the remaining part. And given that you're reducing your payment, that just means you're not going to be able to make all the payments, make the payments on time, or just means that after that many payments, you're going to owe bank an amount. So how do you work that out? What's the final payment? Is to think about what is the present value, and let's just say here, this is after 3 years, 36 months payment, 37, go all the way to 30-year of mortgage, which is 360. So this, your first payment is going to be 4,000 times 90%. So that means I want to calculate present value of my payment, which is 4,000 times 9% times 1 over interest rate 1 minus 1 over interest rate power to 27 times 12. Right. So this one is with my new stream of payments. With the new stream of payments, I am, this is how much I'm paying in present value. But with the old stream, what I have here is that how much do I owe? With my old stream, the present value equals to 4K times 1 over R times 1 minus 1 plus over R power to 27 times 12. This is how much I owe, right? And then what's next here is that these two amounts are going to be different. Not surprisingly, old is going to be bigger than new, right? Old is going to be bigger than new because you're paying more with the original one. And what we have here is that you're going to have old minus new multiply by interest rate power to 27 times 12. And that tells you what is the difference at that point, because this difference tells you the present value of difference at time 36. But the question is asking you, saying, what is the final payment you will be required to pay at the end of the mortgage closest to? So which means that you have to include that in over here.
I think this was actually my finance lab question, or a similar question to.
Yeah, with very similar question. But this one tells you the difference, right? This one tells you the difference. And I think in my finance lab test, what we have here is that I have a slightly different version, is that I have minus X. So what is the, or plus X really, plus X, just treat it like a coupon paying bond where there's a final payment at the end, and those two have to be the same, but it's the same idea where I have two streams of cash flows. There's a difference, and the difference at time 0, which is 36, is old minus new. But we want to find out what is that at the maturity, 360. So it's just sort of compounded by 27 times 12 periods. Any concerns? Any doubts? Any questions so far? No. What's the stat on that question, Daniel?
51%.
1%. Oh,
Yeah.
so still slightly higher than flipping a coin. So that means that.
Bit of a struggle town on that question.
Yeah. All right. Question 6. An investment opportunity pays 4K every year for 6 years. If the interest rate is 6.5% per year and the first payment arrives at the end of the third year, what is the present value of the cash flow provided by the investment closest to? So I'm gonna be apologizing the not enough space, but I'll try my best over here. Is that it's gonna be paying 4K every year for 6 years. But your first one arrives at the end of the third year. And that's what your cash flow looks like, right? It's going to be 4K all the way to year 8, but you're not going to be able to receive anything until time 3. So which means that it's just an present value of annuity, but is a modified one such that the answer is 4K times 1 over the interest rate times 1 minus 1.065 power to 6 because it's for 6 years, and then discount this one back to the present. And this is the key. I'm going to use a red pen. Is that how many periods do I have to discount it back to? Given my first cash flow happens in year 3. 2, right? Why 2? Because if you're looking at this cash flow, if you look at a green line, that forms an annuity, right? Because the first cash flow of the annuity has to be at the end of the first year. So that formula, this formula over here, give you the present value at time 2. At time 2. So you need to discount it further back by 2 periods in order to work out the present value as 0, right? Which is why that's 2. All right, question 7. I don't know why it's question 7 and then question 1 again. I've got a someone asking in the chat box. Because working capital, okay. Will this paper be made available? I could make this available, but some question is going to be slightly different. We'll make a note. Will we get our results? Do they get the result, Daniel?
The results should be available, yeah.
But I think the result is in like
at the moment.
result is like, do they get to see which question is right or wrong? And
no, I don't think we can.
So let's say if someone wants to review their answers to think about, you know, is that technically speaking, is that possible?
I don't know. I mean, it depends on whether or not it allows you to change the options of the test after the test has been taken.
Mm-hmm.
Yeah, I don't know. I'd have to ask.
You have to ask. Okay.
Yeah.
But you should, but Yes, I mean, we wish can make that happen, because there's no problem on our end to release your particular input in your version of the question. So you making an investment. That's the next question. You make an investment that will pay 650 per year for the next 15 years. From 30 months onward, you will receive an additional $200 every 6 months to the end of the 15th year. And if the interest rate, is that different? Do we have a different version of the question?
Yeah, we did put this question in there.
Okay, good. So
it's probably a bit annoying, this question.
All right. So this question, after we both did it, and I think like you have already looked at many interest rate questions, so we decided to not to put in this question in the actual version. Let's script it. Don't need to worry about it. As you can see, it's probably not exactly straightforward. It's a bit tedious. It's a bit tedious. Yeah. All right. Move on. Question 1, you just purchased a new machine for a business. The seller offers you 2 options to pay. You can either pay the entire amount today and receive a 10% discount, or make a down payment of 30% and repay 10% of the machine's value every 2 weeks for the next 16 weeks. If the interest rate is 20% APR compounded every 4 months, which of the following is correct? So you're comparing with two versions. You're paying them fully, which means you're paying them fully, getting 10% discount, you're paying 90%. So option 1, op 1, you're paying 90%. And say, make a number, say $1 million. So 900K, right? Just make, for the point of discussion. Option 2 is that I'm paying 30% today and repay 10% every 2 weeks for the next 16 weeks. So that means we're dealing with, what's the frequency of the cash flow? 2 weeks, right? But the interest rate we're given is APR compounded every 4 months. So that we need to find out interest rate. So in order to find out interest rate, you just need to establish the relationship. The interest rate every 2 weeks, your 26 2 weeks period in a year equals to 1 plus EAR. We're right in the middle. We don't have to calculate it. Equals to 1 plus interest rate every 4 months. 4 months. And how many 4 months do we have? 3 4 months. So that just goes to R 2 weeks equals to 1 plus R 4 months. 3 over 26 minus 1, where R 4 months equals to 20% divided by 3. I mean, it's not an easy number to work with, but you should be able to work out what the 2-week interest rate is. And once you work out the interest rate, which is what we needed, I just highlighted, right? Once we work out the interest rate, and then we just need to establish here, we are dealing with a present value of annuity formula, right? So the down payment is 30%, which means I'm paying 300K today, plus 10%, 100K, because we just say it's a million. Every 1 plus R 2 weeks, 1 minus 1 over 1 plus R 2 weeks, power to how many? What's the n here? That's the key. That will be 8. Why 8? Why 8? Because it's every 2 weeks for the next 16 weeks. So that means you're paying 16 over 8 periods. That's why it's 8 here. And then you solve it, and you realize that the option 2 is higher, resulting in a larger number than 900K. Which is why the answer would be repaying the machine over 16 weeks is more expensive. All right. Move on to the next question. To buy a dream house for 750K, you need to borrow to buy. And the mortgage is a 30-year mortgage paying monthly repayments, and the interest rate is compounded monthly. Assume you have just made your monthly payment. After spending 15.5 years in the house, you decide to sell it. After paying off the remainder of your loan, how much cash will you receive from selling your house if your house sells for $1.2 million? So it's just like an My Finance Lab question. We need to first of all find out how much do I have to borrow. I have to borrow 750K times 80%, right? This is how much I borrow. And then I need to work out what's the monthly repayment. The monthly repayment is equals to how much I need to borrow equals to my monthly repayment times 1 over interest rate, 1 minus 1 plus R, power to 30 years of monthly payment, 360, where R equals to 5.25% divided by 12. And rearrange it, you get C equals to something. And then you need to work out what's the amount still owed. Amount owed after 15.5 years. And that equals to C times, again, 1 R, 1 plus R, power to, here's a key number. You have paid 15.5 years of payment. That means you have 14.5 years of payment that you haven't paid, which is 14.5 times 12. And this is how much you still owe. So to get out to work out the answer, you work out the answer is $1.2 million minus how much you owe from this calculation. That will get you to the answer of this. Is that right, Daniel?
Yep.
All right, good. It is quite tedious for some questions. You have to do multiple calculations at once, right? And an investment opportunity offers a perpetual stream of cash flows of $750 every 52 days. If the interest rate of this investment is APR 4% compounded every quarter and the cash flow grow by 2% per year, I can see someone making a comment. Let me quickly check the chat box. So Lena asking, I'm still confused on how to calculate interest rate. How can the APR have a different compounding period than the cash flow payments? There were a lot of questions where the APR was compounded at a different rate, as I assume the compounding period always matched the cash. So Lena, it is generally speaking in real life, we do give you the APR that matches with your cash flow frequency. But I guess the idea of some of the questions that we, for example, like the previous question that we had, is that it's just to test your understanding about whether you know what interest rate that you need to go for. So it's not default. So it's not just like always getting the APR divided by number of periods, right? So for example, in this question one over here, question one over here, we give you an APR, 20% APR compounded every 4 months, so that you know that 20% APR is just another way to express a 4 months interest rate, right? So whether you should know how to go from 4 months interest rate to 2 weeks, that's what we're testing in that question. Because you can see that the rest is just a present value of annuity formula, right? It's just to show whether you know how to work out from 4 months periodic interest rate to 2 week periodic interest rate. And that is the sort of the challenge in that question. Okay, and that challenge comes up again in question 3, right? So question 3 here, an investment opportunity offers a perpetuity. So that means we need to find out the interest rate for 52 days. If the interest rate for this investment is APR 4% compounded every quarter, we need to figure out what is the interest rate and what is the growth rate. So let's find out the interest rate first. How many 52 days period in a year? 365 divided by 52 equals to 1 plus EAR equals to 1 plus R quarter power to 4. And R quarter here equals to 4% divided by 4, 1%. So you need to use 1% to solve what is the 52-day interest rate. And once you do that, it's not it. The reason why that question is tricky, I mean, we do need some difficult questions to separate, to differentiate. The reason why here that after you're solving for R52 is not it is because what happened to the growth rate? The growth rate is 2% per year, right? So you need to change that growth rate to growth rate, yeah. Power to 1 equals to 1 plus the growth rate for 365 divided by 52. And you need to work out what the growth rate is for your 52-day period, right? And then that's it. And then it's just the rest is just present value equals to 750 divided by R minus G, where R comes from here and G comes from here. And so now let's move on. If a bank pays 12% EAR, what is the appropriate monthly rate? So you can see that we dial down the difficulty as we go through. That question, 12% EAR, just means 1 plus R months. There are 12 months in a year equals to 1 plus EAR power to 1. And you can solve it to get 1.12 power to 1/12 minus 1. And you can see that it's just, I mean, given that the question order shuffles in your case, given the question order shuffles, this is probably not the right, not your version of how you see the orders. Any questions so far? All right, the next one, which of the following statement is false? So part D, the amount of simple interest is total interest plus interest on interest. And again, the key word here is plus. Plus is not right. It's total interest minus interest on interest. That's how you work out the simple interest. Because simple interest plus interest on interest give you total interest. Question 6. Do we have the question in the exam, Daniel?
Which one is it?
You have an outstanding loan which currently requires you to pay. Yeah.
Yes.
All right. So how much is, so here, I mean, there's a shortcut in this question, and which is worthwhile for us to talk about. If you pay an additional $45 today, how much is your final payment?
The answers are wrong there.
The answers over here is, this is not a right version of the numbers. But the trick of this question regarding, I mean, regardless of that we do apologize for that. We didn't have the same question as your exam. But what we're dealing with that is to think about what is the impact of the $45 to your last payment. And it's actually very straightforward. It's just 45 times 1 plus interest rate power to how many periods? Every 2 weeks, that means a fortnightly payment times 8 years, right? Because $45 that you put in addition today will reduce your final payment, right? Will reduce your final payment by the future value of that amount. And R here is, how do we get R? R is the given interest rate is 9% APR with quarterly compounding. So that is 1 plus 0.09 divided by 4 power to 4 divided by 26. And how do we get that? It's just again R 1 plus R 2 weeks, 26 periods in a year equals 1 plus EAR equals to 1 plus R quarter power to 4. And we don't have to calculate the middle part. It's just R 2 weeks equals to 1 plus 0.09 divided by 4 power to 4 divided by 26 minus 1. Minus 1. And you just need to put that into the formula. to get what is the future value of $45. That's just essentially another way of asking, do you know the impact of the $45 today to your final payment? I mean, we give you all that additional stuff, right? It's just to work out the final payment is gonna be 375 minus the contribution made by the original $45. All right, and one more question, then we're gonna opt to the short answers. Question 7: a company has a nominal cash flow of 15,000 per year for the next 10 years, which is expected to grow at a rate of inflation of 3% per year. If the real interest rate is 8% APR with semi-annual compounding, what is the present value of company's cash flows closest to? So a nominal cash flow of 15K per year. And the best way is to work out is that given the nominal cash flow is 15K, if we use 15K directly, that's going to be an annuity. So that means we know that it's going to be looking like this. And we just need to find out what R is, right? And how do we get R? We provide it with inflation rate. We are supplied with real interest rate, though the real interest rate looks a little bit sort of uninteresting because we have to figure it out. But the idea here is that real interest rate equals to nominal rate minus inflation divided by 1 plus inflation. Is that right? Is that the right formula? I actually forgot. That looks right?
Yeah, looks fine.
It looks fine. Yeah.
Now you're making me doubt myself. Shit.
I mean, it looks very familiar, but I just forgot about the yeah. I think so.
Yeah, I'm pretty sure it's fine.
All right.
Google it now.
No, don't. No, I think that's the formula because it's minus 1. So which means that we just need to work out what the Rn is from this equation over here. What's the Rn? And we're given our real, we're given our inflation, but we need to bring our real with the same frequency as the inflation, given all the cash flows in year as well. So you provided that the real interest rate is 8% APR with semi-annual compounding. That means my real interest rate for 1 year equals to my 6 months interest rate power to 2. So your real interest rate for 1 year equals to 1 plus 0.08 divided by 2 power to 2 minus 1. And substitute that number over here, and then that number as 3%. And you can work out what the nominal interest rate is. And then once you work out what the nominal interest rate is, you put that over here. Right. Some of you look like this is, what the hell? You have to do the exam again. Like doing this semester test twice. But rest assured, we did this semester test between ourselves like 3 times just to make sure that the difficulty level is fine. And which is why in our short answers they are a lot easier. So the first short answer question, how many questions do we have here?
3.
Okay, so it's the same version, right? It's the final version, right?
Okay, I don't know what that. Okay, yeah. So it just looks like we've repeated them.
Silver Smith. No, that's fine. Okay, let's go to Silver Smith one. That's that one. 4 marks. Silversmith only uses gold to manufacture jewelry. They are offered an opportunity to purchase 1,000 ounces of silver for $28 per ounce, but delivery will take 1 year. And in fact, that's it. The manufacturer does not need silver since they only use gold. And some of you read it and think that, oh, that's just the same question as the multiple choice question, because we have a question that's sort of saying comparing the cost. Looks like I can buy it at 28 and I can sell it for 30, right? But no, that's not the right answer, because the delivery will take 1 year. So if the delivery take 1 year, that means you can't sell it silver at the current price, right? So which means there's uncertainty here, and your answer, in order to get full marks, you need to point out the fact that here is uncertainty involved, right? The silver space, should they take the deal or not? Will depend on the risk appetite. But here, this is not an upside profit strategy, and there's not a certain $2 per ounce of a gain over here, because there's an uncertainty. It will take 1 year. We give people full marks for different versions of how they write, as long as they talk about uncertainty, as long as they talk about the price is moving. And just given that you're here, we can share some of very interesting questions, interesting answers. Some people say that some people incorporate the interest rate computation over here, saying, well, the growth rate has to be 30 divided by 28 minus 1. But as long as you mention there's uncertainty, right? As long as you point out that you would take 1 year, it's just uncertain event, you would get full marks. If you don't mention that, or if you mention it in a different way, you get some partial marks. And if you simply leave it blank, we can't give you anything, and it has to be 0. Right. So, and then moving on for the second short answer question. So this question is very similar to your election example in week 2. But the only difference here is that in the second option, when a company make a purchase by issuing shares, the share price actually goes down. So which means that if the share price goes down, and knowing issuing more shares will result in a larger outstanding number of shares, you need to work out what's the impact to that. So that means your impact to EPS. So which means that if you simply calculate, simply copy from your lecture example, then you won't get the right answer, because the lecture example is they trade it at the same price as the current market price. And of course, so that means to get the price earning ratio, you need to work out. And let me get my answer over here. Oh, I actually didn't save this one again. All right. So yeah, well, you get the new share price, which is $8, to work out what the new earnings is. And how do we get new earnings? New earnings per share is going to be equals to earnings divided by number of shares outstanding, right? And what's the earnings? Earnings here is $1 billion in earnings. But our outstanding shares is no longer 1 billion. Is 1 billion plus how many shares do I issue? 160 million worth of shares at a share price of $8. So that is, I have to issue 20 million shares. Or 20 million shares. Because if I have to issue shares to buy a company, to make a purchase, I have to issue more shares, and that increase my denominator for my number of shares outstanding. So from that, you can work out what the new EPS is by incorporating the fact that it's going to be a change to the base. And with the new EPS, you can then calculate the new PE ratio, right?
I think what was interesting with that question, Frank, when it came to calculating the new number of shares, I saw a lot of answers that said the new number of shares was 1.2.
1.2, wow. Because they think that it's 160 divided by 8 is 200.
Well, no, because I think it's just like kind of like a
mindset.
Just a quick trying to calculate it quickly. So instead of it being 1.02, they 1.2.
Yep, and then you compare the new PE, the option 2 and option 1, PE and EPS. without having the numbers right written down over here, is that for one of them, the EPS. Do you have the solution you wrote to what's his name? Shane?
Shane.
Yeah.
Yeah.
If you put it down, that would be easier for us to talk about because I don't have it here.
Yeah. So what do you want?
The number, so we can talk about the EPS.
The new earnings per share was 98 cents.
Yep.
And the new price earnings was 8.16.
So this is option 2, and if you compare this one with that one, and then this number with that number, you would say, because given here you are let's say if the manager's compensation is tied up to EPS, then you want to have one that minimizes the impact. So then you will choose option 2. Where if your performance is tied up to PE ratio, per price earning ratio, then you want to pick the one that have a higher PE ratio, because PE ratio is essentially saying how much money, from a shareholder point of view, how much money do they pay in order to buy $1 of your earnings, $1 profit. So if PE ratio is 10, just means people willing to pay you $10 to get $1 profit that made by the company. That's what PE ratio stands for. So, and so that means your answer, you need to discuss, well, the manager will choose differently. And what is the principal agency problem here is that, well, option 2 is more expensive, but depends on the remuneration scheme, how you adjust their performance. They may choose option 2 as the preferred way, because that can maximizing your remuneration, right? Or minimizing the impact to the remuneration. What, do you want to add anything, Daniel?
No, that sounds fine. All
right. Any questions? Okay, then moving on to the last one. So the last question is very long, but it's very straightforward. So this question here involves Tom and Jerry. Tom's thinking about buying a car, and Jerry here goes, you will get $1,000 interest every year. So just imagine how much you'd have saved. So, but the key here is this. So Jerry is saying, so if you buy it now, it actually costs you more than 15K. Just think about it, Tom. So please advise Tom whether Jerry is right. So in your answer, you definitely need to mention about whether Jerry is right. So you have to say whether Jerry is correct or Jerry is incorrect. Or we have a lot of students who didn't include that statement. They're just saying Tom is right. I don't know why we're not asking for Tom, but people saying Tom is right. Tom is right in order to come and see you, right? So here, is Jerry correct? Well, Jerry is incorrect, because regardless of the interest rate, the present value of the cost is $10,000. That's the fact. That's not going to be changed. So what Jerry is making mistakes in is trying to compare the future value in 5 years' time to today's value, $10,000. So people mention about opportunity cost. That's fine, and some people trying to say here, in what ground would Jerry be correct? But the question here is simply saying, is Jerry correct with that statement? Could you say the cost today is 15K? Well, the cost is not 15K, because the present value of your cash flows at time 0 is still $10,000. And discuss whether your advice would change if this is a competitive market or a one-sided market. And again, your advice would not change, because doesn't matter whether it's competitive market or one-sided market, the car costs you $10,000. And here it doesn't involve whether you need to borrow to buy the car, right? We're not talking about here, there's a mortgage involved, you have to borrow money to buy the car, such that the interest rate may be different if you borrow than if you put a deposit. So here, Jerry is wrong, because you can't compare the future value with today's cost. And your answer won't change. Your recommendation won't change, whether that's a competitive market or one-sided market. So it is quite tricky. I would say that last part is quite tricky. All right, that's all for our mixed math exam test. it took us about an hour to explain it, and so it's kind of reasonable for anyone to spend at least minimum 1 hour to do this exam. In the past, we have, we would say it's like 1% higher than the average. So I remember I took this unit from 2016, right? The Mid-Sem exam average has been around 52% every year. So it doesn't matter how easy I make the questions, and it doesn't matter how hard I make the questions. It has just been around 50%. But the final exam is always higher. The mean is always higher. I'm not sure whether that's because just people decided to spend more time studying, preparing for the final exam. But it just happened to be the case. And your performance in Mid-Sem exam grade is not going to be representative of your overall performance, given it's only weight for 20%.
Keep on top of your My Finance Lab and your tutorial participation. There's 40% there. So.
Callie asking, saying, will the answers to the short questions be available? Well, it's in the recording. If you we probably could type up something, but if you get the idea, in fact, Callie, which one you're not sure with, we can explain again very quickly. The last one, this one. Okay, so Jiaxing was saying the last question. So here, the last question, it looks very tricky, but we're not getting you to calculate the future value. So some people saying $10,000 times 1.1 power to 5 equals to $16,000. So Jerry is wrong in that part. It's not $15,000, but that's not what the question is really caring about, because he did say you will get at least $5,000 interest, right? So some people is trying to say it is that part that drives that is incorrect, but no. He's saying if you buy it now, it actually costs you more than $50,000. That is wrong, because if you buy it now, it still costs you $10,000. That's how much it costs you.
What was interesting, Frank, is that you saw a lot of answers that actually did calculate what the future value of $10,000 was. So it's around 16,000 something. But then there were a number of students that realized that once they had calculated, so they'd used the car of $10,000 and compounded that value 5 years into the future and said, okay, the future value essentially of the car is $16,000. It's not $15,000. And then what they did was that they grabbed that $16,000, realizing that they had to compare present value with present value. So then they discounted that $16,000 back, and they said, well, that $16,000 is the same. It's $10,000. So the price of the car is $10,000. So they went around it in a little bit more of a roundabout way, but it's they got there in the end, which is
So really the purpose of this question is to get you to think about the basic rules of time value of money. Is that, can you compare cash flows at different time point? And in this case, it's simply saying, I won't be surprised if that's what people have in their mind when they're buying something, to say, okay, if I save up, I would have $16,000 in 5 years time. Does that mean it will cost me $16,000? Well, that's the opportunity cost you've forgone, but that $16,000 is what you're going to have in 5 years time. It's not directly applicable for you to compare it with the current price as $10,000 today, right? Because the cost.
See a lot of answers as well that were like, well, what's the price of a car going to be in 5 years time? So you could turn around and say, well, the opportunity cost is $15,000, but if Tom wants to buy a car in 5 years time, it's just like, well, what's the price of the car going to be in 5 years time? So you saw answers trying to discuss that. So it's kind of heading on the right track, because you've kind of said, well, okay, Tom's $10,000 would be worth $16,000 in 5 years time, but we don't know what the price of the car would be in 5 years time. So you can see that they're still trying to get on. They're on the right track in the sense that they're now looking at a future value, or two things in the future rather than two things in the present. So rather the $15,000 compared to the $15,000 future value compared to the $10,000 present.
Yep. And someone asked about, so the advice wouldn't change in both cases, the car value doesn't change. That's right, because here the price of the car is $10,000, right? we're not talking about you have to resell, you have to invest, you have to borrow, you have to finance it. No, the car just simply costs $10,000. That's it. Right. I mean, one side of the market just means that you buy it, but you can't sell it back. Right. Which means that there's a friction for you to sell it back in order to execute any arbitrage profit or whatever. Right. But we're not talking about that. It's just simply saying if the car costs you $10,000, it's just if the car costs you $10,000 today. Yeah, as simple as that. It's don't confuse yourself further. But that's the difficulty of this question, because it's too good to be true that this question it's too easy, right?
That made it difficult.
Yeah. All right, and that's it. Yeah. Do we have any questions or anything that you want us to talk about? Dylan?
Oh, no questions on my end.
No
Just
question on your
wondering
end.
though, will there be like I don't know, opportunities to like practice this somewhere?
Practice this. I mean,
Not this question specifically, but you know.
Yeah, I was gonna say that. I mean, given that everyone's time is limited, I recommend that there's so many other things that you can do in your life rather than repeating the same questions. But yes, we will make some practice questions for your final test, final exam, and yes, there will be, and we'll make an announcement once that's ready for you to practice on. Yeah, and so a lot of stuff that what you see in your mid-semester test. It's not going to come up in your final exam, right? Because our focus is on the second half of the unit from week 6 onwards.
Okay, thanks.
No
How
worries.
do you guys, now that I've got some students here, how do you guys find the Excel videos in terms of, like, if anyone's watched them, that is, if you haven't watched them, then it's okay. But it's the first time that we tried to kind of create some kind of Excel videos on tutorial questions, and interested to hear if they help at all.
Any feedback? Any feedback on the Excel demonstration video that Daniel made? Jiaxing saying she found it useful because she never used Excel before coming to unit. That's good.
Cool.
That is our purpose, is that we didn't try to penalize people if they have never exposed to Excel before, and we're not going to put that in the exams to say show us how you move from cell to B2 to C3 and do goal seek. No, but having Excel as your tool is a powerful tool that, especially when doing My Finance Lab test, a lot of you know that the questions numbers change every time, but not the algorithm. So which means as long as you set up the right algorithm, you can get, just by changing the numbers, you're gonna get the answers again. Right?
I tried to show that in one of the videos where I calculated a different question using the same the same working out I did in an Excel spreadsheet. But yeah, I'm going to make a video on drawing an MPV profile, because we did that in investment decision rules, and
Cool.
I'll do a video on how to draw the MPV profile.
You should, yeah. All right, lovely.
And capital budgeting will be fun for Excel, so I've got to get onto that.
Lovely. But yeah, but don't feel nervous if you are still not familiar with Excel, and you can pass, you can get 100% in this unit without knowing Excel at all. But yeah, we're just trying to make your life easier, and life really goes far beyond just exams, right? So it's very important for you to get, to master more tools if possible. All right. Yeah. Thank you for coming in, and we will see you next Monday, and we'll see you in week 12 again for our last installment of this series. Have a good night.
Bye, everyone.
Thank you.
I'm gonna go have dinner now.
Me too.
All
right.
Dinner first.
Bye, Matt.
Take it easy. See ya.